Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning, everyone. Welcome back to another Wealth Coffee Chat. I'm Daniel McPherson. It's Tax Tuesday again, where we try and make tax a little less terrifying and business a little more profitable. And today we're pulling the handbrake on one of the most overconfident deductions and one of the ATO's most audited, which is your car. So whether it's your beat-up Corolla or shiny new Land Cruiser or your business-branded Tesla, I guess people love to think that they can claim it. But just because it's on wheels and has a rego doesn't mean that it's deductible. So this one's juicy because I've seen real clients land in some serious trouble over dodgy or I guess just some misunderstood car claims. So today we're going to go to explain what you can and you can't claim, share some real of what ATOs are doing at the moment, give some case studies on where it's gone wrong and right, and help you stay out of the taxman's firing line. So let's roll into it. So start with the classic, but I use my car for work, I can claim the whole thing. I've seen someone, okay, let's call him Ben the Builder, claimed 100% of his Ford Ranger, said it was for business use only. But during an audit, the ATO checked his logbook and saw that the odometer reading in his logbook didn't match the service record for the same date. So needless to say, the logbook didn't survive. The ATO disallowed all of the deductions and backdated the penalties. So this was a $10,000 mistake. Now, I guess Ben wasn't being dodgy because he thought the car and his toolbox had his logo on the door, that it was a tax write-off. He'd obviously had retrospectively done his logbook, and this is where he got caught out. But I guess the truth is most people overclaim car deductions, not because they're crooks, but because the rules are confusing and everyone's got a My Mate's Accountant story. So I guess what does the ATO actually allow? So we've got the two methods and ways that you can claim. So we've got the first one, which is the cents per kilometre method. So for the 2025 financial year, it's 88 cents per kilometre, and it's maximum of 5,000 business kilometres. There's no receipts required for expenses, but you must have a reasonable basis, sort of like a diary or a calendar, to show what kilometres you actually had done. And you can't just guess 4,998 kilometres and call it a day. So I've seen an employee, Amanda, real estate agent, claim 5,000 kilometres for 3 years in a row. Her income had stayed the same. She had an ATO audit. They matched her tolls, fuel card spend, and noticed that she barely left her local suburb. They called her agency, and her boss confirmed basically that she worked from home most of the time and only did open homes on Saturday. So ATO did their audit and clawed back the last 3 years of work car deduction. So that one hurt. Now, the second method is the logbook method. So this is where you keep a 12-week logbook and you record the odometer reading at the start and the end of your trip, the purpose of your trip, and whether it was business or private in nature. And this is used to calculate the business use percentage. So this is where you can apply that percentage to all of the actual costs. So whether that be sort of like fuel, servicing, insurance, depreciation, or even interest on your finance if the vehicle's got finance on it. And that logbook's valid for up to 5 years. So unless you change your pattern of use or change jobs, or of course, if you get a new vehicle, you have to do one for each vehicle as well. So I guess a real example would be sort of Steve, a mobile physio, logged 82% of business use for his logbook, drove across 3 suburbs every day, visited NDIS clients, had a diary calendar which matched up as well. The ATO randomly audited him for whatever reason, passed with flying colours. And why did he pass with flying colours? It was because his logbook was legit. He had the calendar to match, and there was a clear business case for it. So, I mean, really keeping all the information is key. And then I guess we've also then got the great Ute Myth, which is a classic. So just buy a Ute and you can claim everything on it. So this has been doing the rounds for quite some time. And I guess the issue is the ATO says that Utes are only exempt from fringe benefits tax if the Ute has a payload over 1,000 kilos and is not designed primarily to carry passengers. So this actually rules out some of the really popular Utes, being some of the Ford Rangers, some of the Hiluxes, some of the D-Maxes, I think even some of the Amaroks as well. Even some of the big, the new American ones like the Chevrolet, the Ford F-150, some of those actually have payloads less than a ton. So although some of the Utes look tough, if they've got dual cabs, leather seats, info systems, their payload can be under a ton. So they're considered passenger vehicles, not exempt workhorses. So an example is we had a tradie, Mark, who bought a $92,000 Hilux, financed it through his company, thought he was minimising tax by claiming the lot. The ATO checked the payload. It was only actually 900 kilos, not a ton, and hit him with the disallowed GST claim above the car limit, fringe benefits tax, and a nice little backdated liability because he didn't lodge an FBT return. So I guess the moral of the story is just because it's got good ground clearance doesn't mean that it's more likely deductible. Okay, and then we sort of have the other one too, the heavy and bulky equipment rule. So there's a bit of a carve out that catches people out. So if you're carrying heavy or bulky tools and there's no secure place to leave them at work, you may be able to claim the home to work travel. Now, the keyword is bulky, not awkward to carry. So yes to sort of like jackhammers, ladders, tool chests, and no to sort of the Makita drill, lunchboxer, or Eureka, depending on how big that is. So an example would be an electrician has got to bring their equipment home because a work site was unsecured, carrying 60 kilos of tools in the ute tray. ATO will allow the home to site travel as business use. So compare that to someone who's a sales rep who's tried to claim for their laptop or projector. That'll get thrown out faster than their sales pitch. So let's say you go out and buy a shiny brand new 130k Beamer for your business and thinking I'll just write it off. Unfortunately not. So for the current financial year, the car limit is actually 68,108. Not sure how they got to such a precise figure, but this means that you can only claim depreciation up to that value, and you can only claim the GST up to that value as well. So the other sort of $61,892, that's on you. There's no deduction, no write-off, and it's really just considered a luxury and not a business asset, I guess. So what do the ATO actually look for? So thinking that the ATO won't check, you need to think again. Their systems are getting smarter than ever. So they'll match up your toll records, your fuel purchases, your vehicle rego data from the different state transport departments, your logbook, looking at your work calendar, and then even sort of like Google Map data as well. So if you're an employee, they're likely to call your employer. I've seen a teacher try and claim 4,500 Ks for education-based travel. The ATO rang the school and asked, does she drive to other schools regularly? And the answer was no. She works full-time at one school, and that was basically end of story, deduction completely gone. Now, one thing to note for business owners is you should really register for FBT. So this is I guess a key thing to kind of protect you. So registering for fringe benefits tax can protect you from the ATO if you provide a car to yourself or maybe to staff members and there's any personal use where FBT applies. So if you register and lodge an FBT return, even if it's a nil return, the ATO can only audit 3 years back. So if you don't lodge, there's no time limit. They can go back sort of like 10 years. We've seen a construction business who had company-owned Utes with private use, never registered for FBT. 8 years later, almost a 50 grand FBT bill. So obviously now they're registered, lodge an FBT return and sleep a lot better. Okay, so just to confirm, there is a difference between employees and business owners. So employees, home to work is not usually deductible. You can claim trips between jobs or to see clients, but you need to keep a diary or a logbook and expect the ATO to talk to your employer. For business owners, you can buy vehicles through the business. You can claim the actual cost based on the logbook percentage, and you can register for FBT to avoid the unlimited audits, but they must be managed properly. So if you're in business, structure matters. So don't just chuck the car in the company and hope for the best. There are some things that need to be put in place. So to check with your advisor on those. So key takeaways are track your real kilometres, not just the 5,000. Know your vehicle's payload before assuming it's exempt. Keep a proper logbook, not one just you made up on the serviette at the time. Match your claims to your actual behaviour. Register for FBT if you are a business owner. Get that done. And make sure you get professional advice before you buy the car, not afterwards and you've posted it on Instagram, hashtag work-related deduction. And remember, logbooks are legal documents and they are your proof. So make sure you're doing them up correctly so that there's no arguments with the ATO. So if it's between you and the ATO, guess who they believe, I guess. Spoiler alert, it's not the one with the highlighter and no evidence. So make sure you've got everything in place. So I guess to wrap up, while a car might be one of your biggest costs, yes, you should claim what you can, but make sure you don't guess your kilometres, copy your mate's deduction, or assume you use exempt. Or for that matter, believe everything you hear on the Facebook forums. So this is a deduction that the ATO loves to audit because they know people get it wrong all the time. So if you want peace of mind, a better tax outcome, and a solid defence if they do come asking, make sure you do it right, get advice, and plan ahead. Thanks, everyone. That's it for today for another Wealth Coffee Chat. If you know someone who just writes off their Ranger, maybe send them this episode. So until next time, stay smart and drive safe. Thank you.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.